Hey traders, and welcome back to another episode of King Ramen FX. What if I told you one SMC move revealed almost every key smart money concept in the book? If you have ever struggled to spot clean SMC setups or miss sniper entries, today's video is going to change the game for you. An inverted head and shoulders, I'm going to walk you through this entire SMC setup, start to finish, so grab your notebook. So in this video we are going to talking about a double bottom, a liquidity sweep, a break of structure, fair value gaps, order blocks, and even an inverted head and shoulders. Please don't forget to hit like, and make sure you subscribe for more high-level Forex and crypto content. So welcome back, let's get started. So first we're starting on the 1-hour chart. Before anything else, notice the overall context is a bearish momentum, lower highs and lower lows. Price is driving downward until it reaches a key low. That's where we form a double bottom, a classic reversal signal. But here's the twist, this isn't a signal to immediately buy. In smart money concepts, a double bottom is a liquidity trap. So here is the double top. Peak 1. Peak 2. Retail traders see this as strong support level, they go long early. They place their stop losses just below that double bottom. And smart money knows this. So what do? They drive price down one last time, take out those stop losses, and then reverse sharply. This is our first clue. Liquidity sweep explanation. So after that, draw a trend line to identify your double top and liquidity sweep. So that final push below the double bottom is what we call a liquidity sweep. The market dips just beneath those equal lows and grabbing all the stop loss orders. This is not a bearish continuation, it is a manipulation move. Smart money collects liquidity before changing direction. Price wicks below the lows and immediately gets absorbed and strong buying pressure kicks in. That wick is your first signal that a reversal is coming. This sweep sets the foundation for our shift in market structure. Break of structure explanation. Right after the sweep, price surges upward and break through the most recent lower high. This is your break of structure, you can call it BOS. A BOS is crucial. It confirms the market is transitioning from a bearish structure to a bullish one. Downtrend with liquidity sweep and BOS is in starting of uptrend. This is not random. This is smart money engineering a reversal. At this point, we are looking for price to pull back and give us an optimal entry, ideally into an order block or a fair value gap. Order block entry explanation. Let's zoom in and identify the order block. In this case, the order block, it is the last bearish candle after the strong bullish and BOS move. This bearish candle is where smart money likely filled their long positions. That becomes our zone of interest. When price retraces, we want to enter as it taps that order block. Your stop loss goes below the OB wick. Your TP is based on market inefficiency or recent highs. This is a precise, high probability setup. But it gets even better. Right above the order block, you'll notice a fair value gap, you can call it FVG. That's the area where price moves so aggressively that it leaves a gap between candles and inefficiency. Smart money tends to fill those imbalances before continuing the trend. So now we have a confluence setup. So now if you look carefully in this setup we have liquidity sweep, BOS. Price returns to OB. Inside that OB is an FVG. Inverted head and shoulders pattern. Now here's something extra interesting. Right after the BOS and pullback, the price action forms an inverted head and shoulders, as well known as bullish reversal pattern. But in the smart money context, we view it as a visualization of liquidity engineering. This pattern acts as confirmation, not the trigger. It tells us the market structure has shifted, liquidity has been taken, and now smart money is building positions before the real move. This is smart money idea. Now you can enter a trade right at the order block. Once we enter from the order block and fair value gap zone, we need to manage the trade like a pro. Entry, inside OB, ideally within fair value gap zone. Stop loss, just below the wick of the OB. Take profit 1, recent structural high. Take profit 2, higher imbalance zone or swing high. Let's assume the entry is at first high, with a stop at below the order block and take profit at last high. That gives you a 1 to 4 risk-reward ratio. And if you trade with only 1% risk, you're looking at 4% gain. Professional traders don't need to win every trade, we just need high-quality setups with strong risk-to-reward ratio. Live price behavior breakdown. Let's walk through what happens next. Price climbs steadily out of the order block, and if the price breaks previous swing highs is confirming continued strength. You may notice some minor pullbacks, and that is what we expected. These are opportunities as to scale in if you missed the first entry. As we approach previous liquidity zones, the smart money starts unloading positions. Here's how we handle that. Take 50% at TP1. Move SL to break even. Let the rest run to TP2. You're no longer trading with emotion, you're managing a well-structured position like an algorithm. Final recap. Let's zoom out and break it all down in one last time. 1. Double bottom formed its support. 2. Liquidity sweep took out retail stop loss. 3. Break of structure, BOS, confirmed a liquidity shift. 4. Order block plus fair value gap offered a sniper entry. 5. Inverted head and shoulders, another pattern confluence. Risk management trade executed with high risk to reward ratio potential. This is the smart money concept approach. It's not based on guessing, it's based on understanding how smart money moves price. If you found this video helpful, make sure you like, subscribe, and drop a comment with your favorite concept. And if you want weekly videos breaking down real setups like this, turn on notifications so you never miss out. King Raman FX, helping you trade smart, not hard. See you in the next episode.